at session lows.
I know.
Right now, equity sell-off that probably should have happened on Friday.
Delayed reaction, but we got there.
A little bit of a delayed reaction in this imperfect market. Let's get to the biggest stories in the more than $9 trillion global ETF industry right now. Bloomberg Intelligence is out with its 2023 outlook. We'll discuss the year ahead as Vanguard helps to drive $500 billion of new cash into the sector.
Meanwhile, China has been making slow but visible progress in loosening its COVID restrictions, sparking a comeback in some ETFs, Matt.
And after the weekend, sometimes it's tough to get through a Monday. So we're going to take a look at an ETF that focuses on coffee prices.
And Matt, as always, before we get there, Eric Balchunas from Bloomberg Intelligence with us now to walk us through the flows. Eric, what do you got?
Thank you, Katie, Matt. And look, the party's kind of dwindling down. You know, you talk session lows, but for the past week, really, the S&P's had a lot of down days and it's showing up in the flows. For 6 weeks, we had a real sort of bullish energy in the flows. Look at the top now, Treasuries. You hate to see it. Right here, and Treasuries number 3. Little IVV, it's okay, right? It's not all bad. Aggregate bond ETF, you know, just nothing in here that really tells me investors are excited or bullish, and the overall flows at -6 isn't good. Speaking of that, let's look at the outflows, and this is where it gets pretty bad. You can clearly see all the money that came into SPY and the Qs over those 6 weeks, good chunk of it's left. They clearly did not like what they have seen from Powell or China, and they're just taking money off the table. And VTV, value, that's a lot of money out of the value fund. That's interesting. Value had a nice run. We'll see if more people leave that value trade. Now, Matt brought up Vanguard. I want to look at the league table. It's nice to look at the sort of horse race within ETFs. Each year, it's December. At the top, again, is Vanguard. This will be the third straight year that they took in more money than BlackRock. BlackRock dominated for like 5 years before that. But really, the top 5, these companies right here, they'll call them the big 5, they're all punching within their weight. So no real shakeup here. That said, DFA and JP Morgan, I think, are rising stars. I think, took in more than I would have predicted. So is ProShares. The leverage ETFs did really good this year. But look at all the companies that have taken in money. I think that's compelling and part of the real story because the markets have been so bad. So taking cash this year, I think, is just a bonus, and many ETF issuers have. So Matt, Katie, even though the money goes here, there, these issuers have products for whatever you're thinking. So they're glad it's just coming in.
Well, it's funny that Eric mentions that Vanguard has been at the top of the pack for 3 straight years because I've been covering ETFs for 3 years, and for 3 years, I've written that year-end story. Let's talk about it now with Todd Rosenbluth. He is head of research at VettaFi. It's an ETF data provider and research consultant. So Todd, again, 3 years running, it's been Vanguard. Am I ever going to write a different year-end story?
Well, I think Vanguard and BlackRock and State Street are going to be the 3 dominant players for a foreseeable period of time. They offer broad market asset allocation products that are appealing to advisors. They also have some of the trading-oriented products. But it's been exciting to see some of the other firms enter and have success. JP Morgan with JEPI, JEPI, has been a success story this year. WisdomTree has a floating rate ETF, USFR, that's doing very well in gathering assets. Pacer with the COWS ETF, really strong products. I think you've written about that one also this year. There's a lot of great success stories in the ETF marketplace.
Well, and this whole year has been an incredible success story for ETFs, even as it's been a horror story for IPOs and M&A. Why are ETFs so strong as the market's so uncertain, and do you expect that to continue into 2023?
So short answer, yes. We expect perhaps we're going to see $1 trillion of net inflows in 2023. We're having an impressive year, the second best year ever for the ETF marketplace in terms of flows, despite the fact that we've got a down market for equities and fixed income. Advisors have gotten more comfortable using ETFs. They're gravitating towards these products from a tax loss harvesting perspective for the diversification benefits. We at VettaFi constantly are talking to advisors, and we're hearing them increasingly looking towards the ETF structure relative to mutual funds, relative towards the single stock vehicle. So ETFs are the place to be. This is certainly an ETF show to benefit from that.
Yeah, I want to look at the new launches, right? I think we have a chart of the new launches. There's been 400 ETFs launched this year. Of all the stats they've put out this year, this is probably the most impressive. Typically, if the markets are bad, no one wants to launch a new product because you start off on a bad foot. The track record doesn't look that good. It's amazing how many people still came to market with products. I want to get your take on that, and just maybe if you could forward spin where you think launches will be next year and what kind of stuff we can look for.
Well, we've had a couple of trends that have happened in the ETF marketplace this year. We've had single stock ETFs and single bond ETFs for the more targeted investor that wants the benefits of trading, that also wants the benefits of the ETF structure. We've seen actively managed ETFs punching above their weight, firms entering the new marketplace, either that entered last year and are expanding their products like Harbor, like Neuberger Berman, or firms like Capital Group that's come to marketplace, gathered over $5 billion in just 10 months of net inflows. I think impressing some of the people within the industry that were a little bit more skeptical.
Yeah, I mean, okay, look, we have a bet on this. Will Capital Group ETFs get to $7 billion by February? You're looking good on that. But let me just follow up with this. I feel like Capital Group, they're selling active that's going after the core. And we just looked at Vanguard. How is a company like Capital Group or Fidelity going to bring this sort of close to the benchmark active and push out Vanguard? Isn't that a tough sell?
It is a challenge, but they've got, of course, the history to be able to refer to. You know, Capital Group has broad distribution. Other asset managers, they're taking their traditional mutual fund distribution efforts, moving that into the ETF space. Some are going to have success. Some are going to face challenges in educating the advisors that there's the benefit of using ETFs. But Capital Group, $5 billion. I want to exceed myself on that bet we have. $5 billion is just a success story. But we've seen other firms have success. I think active ETFs are 3 times their overall market share this year in terms of what we're seeing versus the overall asset base. So strong year for active ETFs.
And maybe that's a product of this bear market that we've been existing in. But I actually want to go back to that launches versus closures chart, because I find it really striking that, to Matt's point, it's been a terrible year for IPOs. You've seen just all of these launches. You haven't seen that paired with a bunch of ETF closures, even though a lot of these new funds aren't doing too hot. They haven't really been performing well. They haven't been gathering assets for the most parts. At what point does that white line turn into a yellow line?
So I think we're going to see more closures take place a year forward. So some of the products that have come to market in the last couple of years that are more growth-oriented, blockchain-related products, more thematic products that haven't gained traction are going to close. We're going to see closures happen. We're not seeing it in all the markets, though. So we've seen broad ETFs continue to hold assets. You know, Eric and I have another bet that's out there. I guess this is his show and your show. I'll be able to do it. Well, for lunch, for what it's worth. So it's not as if
it's a steak lunch, though. It's a costly lunch.
But we haven't seen ESG. So ESG has been an area that the asset management industry has continued to hold on to and embrace. They love it. They believe in it. They think
investors don't love it.
Well, investors are holding on to some of their products. So ESGD, which is I think one of the top 3 ETFs, this is an iShares developed market ESG ETF, that has seen inflows this year. So there are products that are gathering assets. It's not the same.
You think that ESG is going to make it, but blockchain is going to fail?
Yes, I do, because the narrow, more targeted growth areas that you're trying to have fun with some of your money and it's not working out, you're going to rotate to something else. But if you believe in ESG from a beliefs standpoint,
you're trying to do good with your money.
You are. Then you're willing to, actually those products are holding their own and holding up relatively well in the broader market compared to IVV and SPY and VOO. So I think ESG products are going to survive for longer than people expect.
All right. Great to get your take. Really appreciate you coming in. Todd Rosenbluth there, head of research at VettaFi, talking to us about the industry and giving us his forecast for 2023. Coming up, forget buying the dip. Some